Okay, let's unpack this. We are diving deep into a major regulatory shift coming out of Thailand. Basically, an overhaul of tax rules that fundamentally changes the financial landscape for anyone planning an extended stay or business investment across Southeast Asia. This isn't just bureaucratic housekeeping. This feels like a strategic move. It affects long-term residency, corporate assignments, and really where regional capital flows. Our mission today is to give you, whether you're an entrepreneur, a corporate team manager, maybe a professional, planning your next long-term assignment, the crystal clear breakdown of these new rules. This knowledge is absolutely critical, especially if you're involved in those long-term corporate assignments or rely on comprehensive extended stay solutions. Service departments, furnished housing trusted by professionals across the APAC region.
It's fascinating because this policy adjustment is essentially, well, it's a dual strategy, isn't it? On one side, they're tightening the financial scrutiny on foreign residents, which creates immediate friction for expats and retirees. But simultaneously, they're launching this major campaign to reverse brain drain, actively attracting skilled PI nationals back home with huge incentives. This raises a really important question. How will managing these two almost opposing forces, sort of pushing out some foreign capital while pulling in domestic talent, how will that influence the long-term economic appeal of Thailand?
Right. Let's start with the change that has caused the most, immediate anxiety in the long-term expat community. That's the fundamental reinterpretation of personal income tax rules for overseas income transfers. For years, the conventional wisdom, and the practice really, was that foreign-earned income was only taxable if you transferred it into Thailand during the same calendar year it was earned. It was a simple loop.
Yeah, a relatively easy-to-manage loop, but that loop is now decisively closed. Starting January 2024, the Thai Revenue Department has made a sharp pivot. The new rule states that all assessable income transferred to Thailand is subject to taxation, full stop, irrespective of the year it was earned.
Right.
So if you earned it back in 2015 or maybe just last month, if you bring it into Thailand after January 1st, 2024, it's potentially taxable.
That is the part that is really difficult to wrap your head around. It changes the game completely for certain demographics, doesn't it? I'm thinking specifically of, say, long-term retirees drawing down U.S. pension or IRA funds. They've been doing that for years. Or maybe an entrepreneur who's finally moving capital into Thailand that was earned perhaps 5 years ago during a successful venture somewhere else, like Europe. How on earth does the government enforce taxation on income earned a decade ago? Doesn't the burden of proof become, impossibly high?
Well, that's the core administrative challenge, you see. And it shifts the legal burden squarely onto the taxpayer. The assumption now is that any foreign funds transferred are assessable income unless you can prove otherwise. So you absolutely must maintain pristine financial records. We're talking bank statements, contracts, income declarations dating back potentially decades, all to demonstrate that the money wasn't assessable income, or maybe that it was earned and saved before these new rules kicked in. We'll get to that exemption bit shortly. This is why for corporate teams and entrepreneurs, the need for stringent compliance and tax monitoring has gone from, just advisory to absolutely mandatory.
Okay, and here's where it gets really interesting on the regional competition front. This shift creates a massive incentive for certain long-term residents to maybe look elsewhere. We are seeing immediate conversations cropping up, focusing on neighboring jurisdictions. Why is Malaysia suddenly looking so attractive, for instance?
Yeah, it comes down to their tax regimes often being much more lenient for foreign remittance. For example, Malaysia primarily operates on a remittance basis for most individuals, meaning foreign income often isn't taxed unless it meets certain criteria, or sometimes not at all, particularly if it's passive income. Vietnam also offers very favorable tax treatment for high net worth individuals, provided they structure their affairs correctly. So when Thailand eliminates its sort of de facto remittance loophole, it forces people who previously enjoyed a simple low-tax environment to choose, either pay the tax or severely limit their time in the country.
Which has implications for the travel industry, too.
Absolutely. For companies that handle extended stay, travel-like service departments, and corporate housing providers, this forces a shift away from selling simple long-term residency. They now need to adapt, maybe promoting shorter stays, more carefully managed rotation packages, things specifically designed to help executives monitor their time on the ground and avoid triggering tax residency altogether.
Okay, that brings us neatly to the actual mechanics of residency. For professionals rotating in and out for assignments, they need that clear definition. Is tax residency in Thailand determined by the type of visa I hold? Is it my work permit?
Absolutely not. And that's the most common misconception, really. Tax residency is officially determined by the duration of physical stay, not your visa type. The line in the sand is clear. Any individual residing in Thailand for 180 days or more in a calendar year is automatically considered a tax resident.
180 days.
Once you cross that 180-day threshold, you trigger the obligation to declare your worldwide assessable income that you've transferred into the country.
So let's play this out. If I'm managing a corporate rotation schedule and I decide to cycle my executive team every, say, 179 days, are we essentially in the clear on the tax residency front? Does that sound like a loophole businesses will exploit immediately?
That is exactly the compliance tightrope many large multinational corporations are walking right now. While staying under 180 days is the primary way to avoid that specific tax residency trigger for foreign income brought in, you still have to be extremely careful. If you start a local business, for example, or if your employment contract explicitly identifies you as a key employee of a Thai subsidiary, you might still trigger tax liabilities on local income, even if you never hit the 180-day mark.
Okay. That's an important distinction.
The 180-day rule primarily relates to foreign income brought into Thailand.
Got it. And just to confirm the rules for local earnings, if you earn money while you are actually in Thailand, say through local employment or from renting out a local property, that income is always taxable, regardless of your 180-day status.
That is correct. Income earned within Thailand, what we call domestic income, remains taxable for everyone, residents and non-residents alike. That distinction is fundamental. Now, there is one crucial relief point built into the new structure. It seems aimed at minimizing immediate panic for long-term planners.
Okay, good news, hopefully.
Well, any savings accumulated in foreign accounts before December 31st, 2023 are explicitly exempt from this new taxation rule. If you can definitively prove those funds were earned and saved prior to 2024, they can be transferred without liability.
Okay, that's significant.
It offers a vital window of relief for those with pre-existing funds, absolutely. But again, the burden of proof is on you.
Right. Documentation is key. What's also fascinating here is the enduring role of double taxation treaties. These treaties, agreements between Thailand and various other countries, they're highly complex, but they might offer a way to mitigate the financial shock. Yes. Could you give us a quick practical example of how a treaty might help someone?
Sure. Let's use the common example of a U.S. retiree drawing a pension. Say that pension is already taxed at maybe 20% in the United States. Without a treaty, Thailand might, under the new rules, try to tax the full amount again when it's remitted.
Double taxation. Ouch.
Exactly. However, under the specific double taxation treaty between the U.S. and Thailand, the treaty is designed to prevent income from being taxed twice. So Thailand might credit the tax you already paid in the U.S., meaning you'd potentially only pay the difference, if any. Or, in many cases involving pensions specifically, the tax liability in Thailand could actually be reduced to zero.
Okay.
But, and this is a big but, this is very jurisdiction specific, it depends entirely on the wording of that particular treaty, and it absolutely requires professional tax guidance because if you get it wrong, the penalties can be severe.
Understood. It is abundantly clear that the definition of a long-term resident, financially speaking, has become exponentially more complicated. But we mentioned this is a dual-track strategy. So while Thailand is creating this new friction for foreigners, it is simultaneously throwing open the doors for its own talent. Let's shift focus to that aggressive incentive program aimed at reversing brain drain.
Yes, this is a major strategic pivot. It seems clearly aimed at driving high-value, high-tech industry growth. They realize, I think, that they can't rely solely on foreign investment. They need that high-level human capital. And the primary target is the highly skilled Thai expatriate who left maybe for education or work experience abroad.
And the financial incentive is quite compelling, from what I understand.
It really is. Returning Thai nationals who qualify for this specific program will benefit from a fixed income tax rate of just 17%.
17%, flat rate.
Flat rate, considering the standard progressive tax brackets in Thailand can reach up to 35%, a fixed 17% rate is a substantial financial argument for coming home, a very powerful pull factor.
Definitely. But there are strings attached, presumably.
Oh, yes. The requirements for that 17% rate are quite stringent, ensuring they capture the right profile of talent. The individual must hold at least a bachelor's degree. And critically, they must demonstrate a minimum of 2 years of prior international work experience.
So they're targeting globally seasoned professionals, not just recent graduates.
Precisely. People who've worked in competitive international environments.
That focus on global experience is key. But this isn't just a benefit for the individual returning, is it? The corporate incentives here sound massive, too.
Absolutely massive. To ensure companies actually hire these returning experts, the government introduced a major lever. Employers in certain targeted sectors receive a 50% tax exemption on the salary expenses for these skilled workers.
Wow, 50% off the salary cost for tax purposes.
Exactly. That is a game changer for corporate recruitment budgets. It makes hiring a highly experienced returning Thai national significantly cheaper, potentially, than importing foreign talent for the same role.
And which sectors are we talking about?
Well, the sectors being targeted are critical to understanding Thailand's long-term strategic goal. They're really focused on boosting innovation and productivity in areas like smart electronics, advanced manufacturing, next-generation automotive technology, and also the biocircular green or BCG economy. This program, it's set to run until December 31st, 2029, so it's a multi-year push designed to fuel this industrial pivot.
So, stepping back, what does this all mean for the Asia-Pacific region? We are seeing Thailand managing these two distinct demographic realities. Increased financial friction and complexity for foreign residents, juxtaposed with these overwhelming financial incentives for its own highly skilled nationals to return.
It's a delicate balancing act, isn't it?
It really is. So for you, the listener, whether you are managing corporate relocations or maybe planning an extended stay in this region using service departments or other long-term solutions, your homework just tripled, basically. The critical takeaways are clear. Your duration of stay, that hard 180-day threshold, and the source year of any transferred income must now be tracked with extreme, almost surgical precision. Long-term corporate assignments now require rigorous internal compliance planning to manage tax exposure proactively. You can't just wing it.
Precisely. The overall strategic vision is complex, maybe even contradictory in the short term. You've got the shift in overseas income tax policy, which sort of encourages shorter, more agile travel patterns for expats and corporate teams. It favors rotation over permanent settlement, perhaps.
Right.
But simultaneously, the skilled national incentives promote long-term investment in high-tech sectors, focusing on establishing a deep, skilled domestic talent base. This dual-track strategy could fundamentally change the kind of economic activity Thailand sees in the next decade. A potential move away from simple long-term residency towards more targeted industrial strength. So the big question for you, I suppose, is will these dual tax policies be enough to successfully pivot the country's economic cord toward innovation? Or will the friction created for foreign residents and investment potentially outweigh the boost provided by the returning nationals? That's the multi-billion-dollar question.